When people talk about real estate investing, one of the most confusing things you'll hear is this idea of A, B, C, and D neighborhoods. Most beginners think A-class means rich, C-class means bad, and that's the end of the story. But smart investors know it's not that simple. Today, I want to break this down in a clear, practical way so you actually understand where smart investors really put their money and why. This decision matters for your cash flow, risk, and long-term wealth. Let's start with the big picture. Real estate investing is not about buying the prettiest house. It's about buying the right asset that fits your strategy. Every neighborhood falls somewhere on a scale based on income levels, property condition, tenant profile, crime rates, schools, and overall demand. These factors directly affect your rent, your expenses, and your peace of mind as an investor. A-class neighborhoods are usually newer areas with high-income residents. These are places with great schools, clean streets, strong job markets, and beautiful homes. On paper, they look perfect, but here's the reality most new investors miss. A-class properties usually have very low cash flow. You pay a premium price, your mortgage is high, and rents don't rise fast enough to create strong monthly income. These properties are excellent for appreciation and stability, but they often don't help you quit your job or build passive income quickly. Big institutions, funds, and wealthy investors love A-class because they care more about capital preservation than monthly cash flow. Now let's talk about B-class neighborhoods. This is where things get interesting. B-class areas are typically working professional neighborhoods. Homes are slightly older, maybe 10 to 30 years old, but still well maintained. Tenants usually have steady jobs, crime is moderate to low, and demand for rentals is strong. From a smart investor's perspective, B-class is often the sweet spot. Prices are more reasonable, rents are solid, and tenants tend to stay longer. You get a balance of appreciation, manageable risk, and positive cash flow. Many experienced investors quietly build their portfolios in B-class neighborhoods because this is where wealth grows steadily over time. C-class neighborhoods are where a lot of beginners accidentally end up without realizing the full picture. These are older areas, often with lower income tenants and higher maintenance needs. On the surface, the cash flow can look amazing. Cheap purchase price, high rent ratio, and big numbers on spreadsheets. But here's the hidden cost. Repairs are frequent, tenant turnover is higher, and management becomes critical. If you don't have strong systems, reserves, and a good property manager, C-class can quickly turn from opportunity into stress. That said, skilled investors who understand systems and numbers can make very strong D-class neighborhoods. This is where smart investors are very cautious. These areas usually have high crime, unstable tenant bases, and serious property condition issues. Yes, properties are cheap, but cheap doesn't mean profitable. Vacancy, damage, legal issues, and unpaid rent can destroy returns fast. Most long-term successful investors avoid D-class completely because the risk is simply not worth the reward. So where do smart investors actually buy? The honest answer is not one single letter. It depends on your goal. If your goal is passive income and lifestyle freedom, many investors focus heavily on strong B-class and selective C-class areas with good management. If your goal is long-term appreciation and tax efficiency, a class might make sense later in your journey. Smart investors don't chase hype. They chase numbers, demand, and sustainability. Another key thing most people forget is taxes. Real estate is powerful because of depreciation, cost segregation, and cash flow that's often taxed at lower rates. When you combine the right neighborhood with smart tax planning, your real return becomes much higher than what you see on paper. This is why experienced investors always think beyond just the purchase price. The biggest mistake beginners make is copying what looks good on social media. A mansion in an A-class area looks impressive, but it may not pay you every month. Smart real estate investing is quiet, boring, and incredibly effective when done right. It's about building assets that work for you while you sleep. If you're just starting, focus on understanding your market, running conservative numbers, and choosing neighborhoods that support your financial goals. Wealth in real estate isn't built overnight, but with the right strategy, it is absolutely predictable. If you want to learn how smart investors really build passive income, reduce taxes legally, and grow long-term wealth through real estate, make sure you subscribe to Smart Realty Secrets. This channel is all about practical strategies that actually work in the real world.